Solana is getting ready to take off to make all-time new highs today. I'm going to show you how you can apply proper risk management. So even if you're wrong, you still make money. And if you're right, you make an incredible amount. So if you like today's content, like, subscribe, hit the bell notification. If you don't know me by now, my name is Jiggy. I'm the award-winning author of The Extraordinary New Venture Capital Opportunity, How to Invest Like a Pro. Been featured in the best-selling book, High Probability Trading Strategies, back in 2008, where I only used to focus on currencies, but now exclusive on cryptocurrency. So let's dive straight in. Quick recap. On the 21st of Jan, we did a macro picture thesis on Solana. You can go back and watch the video. It said Bitcoin and Solana emergency update, and we covered a lot of details. And then we zoomed in to say, look guys, Solana is approaching this very key zone of a particular 1, 2, 3, 4, 5 wave sequence in a price zone. We're going to cover what that means in detail. If you're not familiar with Elliot Wave and Fibonacci, we're going to really break things down for you today. Then we also did a follow-up video, which was on the 24th. And we did, we really zoomed in. But now we said in this particular video, 3 days later, we said, look, we've entered into this price zone. We went into particular detailed entry strategies with risk management, how we become a risk-free over here in terms of if this market movement happens, take money off the table, back in your pocket. So even if the worst case scenario, you still make money. But what we anticipate is this particular price target. And we're going to cover today, again, the details why and how you can do this for yourself, because it's important that you be able to do this for yourself when it comes to all cryptos. So with the markets, they're moving 5s and 3s, 1, 2, 3, 4, 5, and then typically followed by a 3-wave correction, ABC. And what you're looking at right now is literally the position of Solana. This is literally Solana. And we are going to go into our live chart, break this down A to Z. So, teach a man how to give a man a fish, feed him for a day, teach a man how to fish, and women, feed him for a lifetime. And we want to make sure you have the skill set. So let's dive into a live chart. So what we're going to do today, it's going to be quite cool today, is I'm going to give you the reference point. How do we take the data from Solana from December 2020, right? We're going to look at the macro, and we're going to really zoom in to what's happening right now. We can see there's been a trend reversal as anticipated. And what I'm talking about there is this movement to the upside. Look, it's done this reversal. What does that mean? What's that likely to mean? And how we want to interpret that data. But what we're also going to do, which is going to be really cool, is we're going to reference my course. Yes, I've got a course that breaks down Elliot Waves and Fibonacci. This is what the course backend looks like. You click on Elliot Waves. We're going to use this as a reference today. So I cover the foundation. We cover the details of Elliot Wave, pretty much all the guidelines that you need to know. So we're going to jump into, lesson 3 in the intermediate section. I'm not going to watch the whole lesson. I'm just going to zoom forward to a particular section. So it's easy access. So you kind of get a bit of a feel and a flavor of what this is. So I break down some of the rules and guidelines. And what we say here in this particular lesson is Elliot Wave counts. The real fundamental foundation is it moves in 5s and 3s. And when they're identifiable patterns, we want to leverage that information. So first, we're going to start off with pattern, Elliot Wave pattern, and we're going to go a bit back and forth as well. And by the way, if you want the course, I actually have a free Elliot Wave and Fibonacci Masterclass, which gives you a real flavor of the course, but we're running like a 90% discount. The course is normally, what's the course normally? The course is normally $997. And you're going to get it for $97. So we're doing some ridiculous discount at the moment. But I'm going to show you how you can use it, how it's practical. So first, again, we're going to look at this 5-way count. Do we see a 5-way count with Solana followed by an ABC? Well, we know we do because we just said it in the previous slide. But now we start with pattern. So what we're going to do here, there's a particular tool, and I'll show you how to use this in the course, called Trading View. Trading View, there's a free version. There's a paid version also. I am going to use this tool to count. Here it looks like a nice wave 1 on a real intermediate count, ABC of a wave 2. By the way, I did a video on this back in, I think it was June, July, it was July, where we pegged this low bang on using what I'm about to show you. There's a very clear wave 3, a nice wave 4, and then a wave 5, right? And again, we did a follow-up video on this. Let me just change this. Yeah, it's intermediate count. That is cool. And then we did a follow-up to say, look, after a 5-wave sequence, we anticipate a correction to the downside, and we said this in advance. This is the key thing. What we're teaching here, what I'm showing you here, is leading indicators where you're looking at what the market is likely to do tomorrow, not what it did yesterday. Because yesterday you can't make money, whereas tomorrow you can. So we have to make the decision today on what we can do tomorrow, what is likely to do tomorrow. Excuse me. And what we're looking for is probabilities and knowing that we can never have certainties, only probabilities all the time. So next, I'm going to go through this relatively fast. We go a nice wave A, a nice wave B, and what looks like to be forming a wave C, right? This is the intermediate account. So what does that mean? Well, as I cover in this lesson, you'll see here, I want to make this clear because sometimes people get it, but in the course you'll get it more detail, is I cover wave 1, wave 2, wave 3, wave 4, and wave 5, but you'll see there's this green number above called a wave 1. And what that says is, once a 5-wave sequence is complete and then ABC, the next expansion of the market tends to happen. The next expansion, which goes into a new 5-wave sequence. And that's what this green line is. This is saying this is the new wave 1. So this now becomes a wave 5 of a wave 1. And this now becomes, rather than just the ABC, it becomes a wave 2. So this is perfect because this is exactly the scenario that I'm seeing for Solana on a real practical note. So we just jump back into Solana. We're saying, okay, so we can use this, just get the thesis or the thinking very clear. We're saying this looks like a macro wave 1 and a macro wave 2. Now, because the wave 2 has not been confirmed, we put a question mark. And the question mark simply is just a reminder for us to say, look, probabilities never certainties. We believe this is a wave 2. If it is a wave 2, this low should hold, right? That's the key thing. So now what we're going to do is jump back into the course. We'll break it down in a lot more detail, but I just want to jump back out and go into Fibonacci now. So we go, okay, we're happy with the price, pattern. Actually, there was one other thing. What I also cover in the course is that wave C's, which is this wave here, wave C, often breaks down into 5 waves. And if it's clear, we want to use that information. And this Solana right now is just textbook, just the perfect example for this. Because look at this. Right, you can probably spot it yourself. If you've never done Elliot Wave and Fibonacci before, if you're counting to the way down, right, counting these waves, do you see a wave structure on the way down? Right, do you see it? Right, well, what I see is we got this really clear move to the downside, what we call a wave 1, a move to the upside, even an ABC structure. We got a move to the downside. It's bigger than the previous move. We've got an ABC structure, which is textbook. And we've got another move to the downside, right, down to here, right? And we're going to double click. And we just change that to a micro. So now we've got 3 degrees of wave counts. Right? This is, I'm simplifying it, but it doesn't need to be complicated. Like if you can do this, now you've got 3 degrees of wave counts, which is really powerful information, really powerful information. I'm going to show you how powerful as we go a bit further. But by itself is not good enough. We want to stack the probabilities in our favor. So from an Elliot Wave pattern perspective, this is just like, this is just beautiful. And you can use just this. But now we're going to add in Fibonacci price ratios. So now we're going to jump back into this course. We're going to scroll down. We're going to go into the Fibonacci section. So I've broken it all down to foundation, intermediate, and advanced. You know, welcome to Fibonacci. We don't need to go to the foundation. What we want to do first is Fibonacci retracements. But what in particular, lesson 3 is how to do a wave 2 retracement. Wave 2 retracement in particular, we're just going to go into this lesson. I'm just going to zoom forward just to the screenshot. All right, we don't need to hear you, do you get it? All right, let's just zoom in. We go to the foundation. Yeah. So what we're going to say is, I'm just going to zoom in. There we go. So in the lesson, what I show is the key ratios that a typical wave 2 corrects to over and over and again and again. And what I say in the lesson is, if I just get this here, is when the market moves up, it tends to have a correction. And wave 2s tend to be the biggest correction because the market doesn't know that there's a trend reversal occurring, right? Even on a macro and a micro. And the 3 typical ratios is 50%, 62%, and 78.6. And the software allows you to just click down here, click up here, and it draws the ratios for you, right? So that's what we're saying over here. So now that's the theory, right? We want the practical. So when we go back to Solana, what we're doing, we're going to go for the macro picture first. We want the macro retracement of this whole sequence to the upside. You go, Jiggy, does it really like pan out that frequently? I go, yeah. Human psychology. Arthur C. Clarke says it nicely. He says, any advanced science is indistinguishable from magic. And what we're looking at here is psychology, which is a science. And what we're saying here is this is a wave 1 to the upside. And what we're looking for is what's the typical range that a wave 2 corrects into. So we go, great. Let's go into that. All right, so we're literally just going to do what we saw in the lesson. What we're going to do is we're going to take this retracement tool. In TradingView, it's called Fib retracements. We're going to click this low. I'm measuring this low down here on the left, but I click it just in line with the top of the wave 1, just so it's pretty clean. And then we're going to take the top of the wave 1, and we're going to click this cog, and the 3 ratios that we want is 78, 62, and 50%. Why? Look, that's in the theory. Look, there we go. Look, 50, 62. So we cover the key ratios. It's important to know the key ratios for the key waves. That's important, because if you don't get that right, then you don't get the powerful information. I'm just going to delete these. I'm going to delete this just for now, but we'll come back to entry strategy in a second. Right, so now we've got these broad range to say, okay, a retracement, typically we don't want to look to enter this trade until we've hit a minimum of 50%. But when we're now looking for a confluence of events where pattern, which we did in the first instance, is coinciding with price, Fibonacci price. So now what we can see is that this wave 5 of C of 2 is coinciding with this 62% retracement, right? We can get rid of the other 2 and go, we're in this zone right now. That seems to be the powerful ratio. And you might be thinking, well, I'm thinking, is that enough information? I go, no, we want more information. So we jump back into the course and we go, yep, thanks, Jagir. That was great, wave 2. All right, but we want more information. So we're just going to jump back out. And I want to go now into, let me just look at this. I'm doing this fresh off the cuff. I want to go for the ABCs. Let me just have a look here. I'm looking for what I want. Wave 2. I'm looking for, where's what I'm looking for? Oh, here we go. Yeah. Intermediate. So sorry, that was the foundation that we're looking at. What I'm looking for now is the intermediate. What we're going to go into is something called external retracements. External retracements is really, really key. Most people don't know about this. I was just looking at the course. Normally I don't go through the course because I got it all in my head. What I want is ABC external retracement. Lesson 11 on the intermediate section. We're going to go for, this one here. I think it's this one that I'm looking for. All right, it's going to forward it. Bam. Yep, that's fine. Yeah, here we go. This is what we're looking for. Now, what this is so powerful, It is unreal. What we're saying here is, in fact, I'm gonna zoom in like this. Can I do this? Yeah, this will work. All right, what I show you in this lesson, because what we're looking to do is add the pieces to the jigsaw puzzle. Is we're saying that this wave B, and we have a clear wave B, has a direct relationship with this wave C. And there's something called an external retracement, and there's these 2 ratios called 1.272 and 1.618 as an external retracement. And wave C's often end in that zone, and we want to take that information into account. So what we're going to do is we're now going to use that information, because I'm basically what I'm trying to do here is, the method behind the madness, so you have these tools. Now, because we're using an intermediate wave count, I'm going to use the extremes on the candles. So basically what we're going to do here is we're going to measure this wave B using something called, it's the retracement tool. But what we're going to do here is we're going to click that low to that high, but we want the ratios of 1.618, which is right down here. That's the extreme. So we know we've gone just beyond the extreme of a typical end of a wave C external retracement. This is more of a confirming indicator. That's why I put it into the intermediate part of the course. But my absolute favorite, which we're now going to jump into, is the advanced. I call it advanced. It's not that. It's advanced because most people don't know it. It's not that difficult to do. So what I want to do is let me just jump back into the course like this. We want to go into the advanced section. There's a few other things as well, but I'm just kind of giving you a macro picture. Now we can go into the advanced of Fibonacci price extensions. This is my absolute favorite. And what we're looking for is lesson 18, which says Fib price extensions for a wave C. You see that? We want this wave C. So we're going to click on this lesson. Yeah, all right, let's just get to the point. Give me the ratios. All right, here we go. Bang. This is beautiful. This here is game changing. This here, what I'm about to show you, most people have no idea about. This is like a top-notch secret. But, you know, it shows up time and time again. What we're basically saying here, with Fibonacci, it says it down here, actually. Yeah, here we go. Wave C has a very direct relationship to wave A. And more often than not, they're actually the same. The maximum is 1.618, which is rounded up to 162 or 62%. But what we're looking for is a cluster in terms of the other things that we're taking into account to coincide with what we've just seen. So now, if we just jump back into Solana, if we just zoom back out, we go, yep, it's all fine and dandy. This is this is more important than the external retracement. Much, much more important. Yep. Where's my retracement gone? Let me just make sure my external retracement disappeared. Let me just pop that back in. I was thinking there was a line that was missing. It was this one here. Boom. Boom. There. There, that's the one. All right, so now what we're going to do, go back to a line chart. Line chart just make it easy to see. Is what we're going to do is we're going to measure this wave A. And we're going to project it from this wave B. And you'll see it's going to give us a really clear, we're seeing if there's a cluster. So we're going to use what's called, in trading view, it's called trend-based fib extensions. I call it alternate price projections, but in trading view, it's called, fib? Trend-based fib extension, that's what they call it, right? So basically what you do is you can click up here, click down here, click to the top of wave B. We're going to click the cog, and then what we want is the 100%. That's the key one, right? And we can see it's right, it's like bang on. Look at that, look at that. Like if we just zoom in, it doesn't get much better than that. It's literally right in that zone. So now we've got a really tight cluster. We are going to finish off with fib ratios. There's one other key one. Because we did a 3 degrees of Elliott wave counts, and one of them was a very clean 1, 2, 3, 4, 5 of a wave C, we've measured the wave 2 retracement. We've measured an ABC relationship. But now we want to also do a 5-wave sequence to see, are we in that typical zone? And we are. But what I want to do here is if I just jump back out, and then we just jump back into Fibonacci, we want an end. There's a few other detailed things we can do, but I'm just going to cover the key ones with you today. Is an end of wave 5. Here we go. Lesson 7, Fibonacci price extension for a wave 5. So it just covers the key ratios. And there's 3 key ratios. And again, I'm just going to forward to the visual. Now keep in mind, right, I'm showing you in the lesson on the way up, as in bullish. We're going to do it on the way down because the same applies for the reverse. So what we're going to do here is we're going to keep it really, really simple. But this is one of the most powerful ratios that you'll see time and time again, is we're going to measure the beginning of wave 1 to the top of wave 3. We're going to project it from the wave 4 extreme. And a couple of the ratios that we're looking for is the 62% to the 100%. And the other ratio, is 38%. So in the lesson, I've got it here. This is the most typical, 100%. And we also want to be aware of these ratios here as well. Sorry, it's more this one. Ignore this one. That one's the different ratio. We're going to focus on this one here. 38, 62, and 100. More often than not in crypto, I found is 62 to 100 that we really want to be aware of, right? So now, if I just close this and I go back here, this is what I just do time and time again. We're going to measure the beginning of this wave 1 up here. We're going to go down to this, what looks like a clean wave 3, and we're going to project it from the top of this extreme of wave 4, and look, it clusters over the others. Now, this is called a very high probability support zone. So this is where we're looking to find psychological support based on pattern, 3 degrees, based on price on 3 degrees, and now we've got this nice clean. So this is why and how we said this is likely to have a trend reversal. Not guaranteed. Then we just do the next bit. This is in the course, but I'm not going to jump back and forth in the course no more. I'm just going to go to the top left. We are looking at the weekly momentum. The momentum has now made a bullish reversal, blue line over the red. That said that we should anticipate market to be sideways to up for the coming few weeks, 4 to 8 weeks, give or take. So that is saying the trend is your friend. So the trend is looking to be up. And then we said on the next bullish reversal, we should enter. So I'm going to take the data back just a couple of days from when we did the analysis around here. And what I'm going to do here, we're going to get detailed now. We're going to get detailed because we're going to use a couple of other things as well, which is important, is we're going to go to a candlestick because it just becomes easier to see the day-by-day bars. It's the daily chart. We've got this down here on the trend reversal on a daily chart, which says now the momentum on a daily is up, on a weekly is oversold or up. So now we've got momentum on 2 degrees, we've got pattern on 3 degrees, we've got price on 3 degrees. They've got a confluence of events, a lot of things saying, wow, okay, it looks like there's a very high probability Solana's made a low and we're going to go on to make all-time new highs and smash all-time new highs. That's the key here. So now when we've got this bullish reversal here, what we say as an entry strategy, there's a few different entry strategies, but one of the easiest is on a 1 bar high, we can enter the trade. So we go, bang, this is a 1 bar high, right? So after, let me just make sure that was after. Yeah, so after the bullish reversal, boom, yeah, perfect. Actually, I'll keep that there just for reference. All right, so I'm just going to zoom in, so it's nice and clean and obvious for us. So this over here, I'm going to get this magnet, so it lets me click the top here. Yeah, perfect. All right, so basically what we're saying now is we believe this low has been made, this wave 5 over wave C over wave 2, right? So now we're saying our risk is going to be, we're going to put a stop loss, if we use a stop loss, down here. So now what we're saying is this is our risk, but a couple of days have passed, so we're going to go, right, we're going to lower the entry point down here. So now this is where the entry point is. And what I want to do, I want to just touch on this because I've updated this recently. This here, you would have seen me use this. Again, it's in the course. I've added this. You'll go into, in the course, we go into categories. I've added this section here, just risk management. Just click, and it's just a downloadable Excel sheet. You just click here, and you just download the Excel sheet down here. I'll probably do an extra training on this, but this is what I'm covering right now. And what we're going to use is this over here. What we're saying is, let's just say you ever had a $30,000 account. You're risking 3% to find out if you're right. And if you're right, we're going to see how much money we make. The entry point is what we're going to say is currently 1 bar high on this example is $99.83. 99.83. I like to add 5, so we're going to go 88 just to give it a bit more space so the market enters us into the market. That's the ideal scenario. And then the stop loss is going to be on the 1 bar low, on the swing low, should I say, the wave 2 low, because that was what would invalidate the wave count. It says 80, 83, so we're going to go 80, 78. Right? So now this says we can, with our risk tolerance of 3%, if you change it to 2%, it changes. If you change it to 5%, it changes. But good practice with trading is 3% as the maximum. There's a few other things as well. We can buy 47 tokens. It's going to cost us 4,700. But if we sell at the 80.78, we'll sell the full amount of tokens and we'll get returned 3,800, which would be a loss of 900. Basically, that is your risk tolerance. That's your risk. We're risking 900. But why we're risking 900? Well, if we hit our targets, now this is where it gets different ball game. This is going to just basically separate the men from the boys and the girls from the women, or the women from the girls in terms of risk management. What we're going to do is we're going to have 2 targets. So we can get rid of these now, right? This has served its purpose. We don't need this information. The pink box does what we need it to do. I like to keep the pink box there because it just gives me a reference. And if the market does take off, we can delete it and just look for the next piece of analysis. What we're going to do now, again, and I want to do it detailed because it's important. It's important. Is the minimum expectation is after a 5-wave sequence, any 5-wave sequence, which is what we see here, 1, 2, 3, 4, 5. After a 5-wave sequence, what we anticipate is a minimum of a correction. Even though our macro thesis, my macro thesis, if I just change it back to a line chart, keep it nice and clean. My macro thesis is, as you know, This looks like to me a macro wave 1, a macro wave 2, and then if we just jump back into the course, this is, and again, I'm doing it like this because I put a lot of time in this course, a lot of time. So you have this, so it's easy for you to just use as a reference, like we're using it right now. Is we're just going to go to wave 3, lesson 16, price extensions for wave 3, right? Again, you can kind of watch the whole thing, but the key point, the key ratios that I'm looking for is more often than not, it's these two here, right? Wave 3, basically what we do is we simply measure wave 1, that's what this line here, and we project it forward from the low of wave 2, and the typical psychological price zones from a buying and selling psychological behavior is 1.618, which is 162%, to 2.618, which is 262%. They're the two key ratios, right? And you see me use them over and over and over and over and over again. So what we can do for our macro thesis is put that into play. So what we do is we literally, I've done it already, but I'm going to do it again just so you see it, is we're going to use the trend-based fib extension tool. We're going to click this low. I'm going to do it here on the left, but I'm going to marry it up on the left. So I'm going to do it on the right, but I'm going to marry it up on the left to make sure we get the wave 2 low zone. And again, this is more for indicative purposes to get a feel for what's likely to occur. Let me just click this low. Bam. COG. The two ratios that we want is 1.618 to 2.618. We'll be conservative. We'll say, even though we've got two ratios here, the one that we're going to look for is this one, right? This one here, that the market we're anticipating will hit $491, $491 or thereabouts, right? So then when we do that, what we type in for exit 2 is $491, right? Bang. And then for exit 1, again, we don't know if it's going to play out though, because we can only do probabilities and never certainties. So now what we're going to do is we're just going to just zoom back in to this part and we go, yeah, remember what Warren Buffett says, right? Rule number 1, never lose money, right? So what we're going to do is we'll say, okay, after a 5-wave sequence, if we're wrong, we should at least get a particular correction before we get a further move to the downside. Because there are things called complex corrections, which are hard to anticipate. So this is what we need to prepare for, right? Anything can happen. So what we do is we simply take this high of this wave B to the low of the wave 5 over C over 2. Basically, it's low to the high, high to the low, should I say. We want 50%, 62, and 78.6. And to be conservative, we want to get risk-free if we get entered into the trade and it gets into this zone here, 144. So if we can get risk-free and exit half of our position at $144, that's going to allow us to take our money off the table and then move our stop loss to break even. Stop loss to break even. So this is the thinking. This is the game changer. This is, if you're wrong, you make money. You make a small amount of money, or you break even, or you take a small loss. That's the three outcomes that we have to know that are possible. So now what we do is we say, let me just go back. What was the price? For 50%, it was 144. Let's call it 144, right? 144. 144. Bang. So if this plays out as anticipated, we are risking 900 to make 10 grand, right? 900 to make 10 grand. It's 11x. I updated the spreadsheet. There was a couple of kinks in the math with my previous version. So now this has been updated in the course. If you want access to this, it's in the course, so you can download it and use it. And it just tells you the net risk reward. So the gross, these are the gross numbers. Net means after cost. So we're risking $900 to make $10,000. That's what we're doing. We are looking to get risk-free quite fast and sell half of our tokens if we hit $144, which is that initial move. And then we're looking to sell the other half at $490. And there's particular strategies that we're not going to go into today, but this is just the high-level thinking. So if it pans out, it's 11x. But what I want you to do is assume you're wrong. What's the worst case scenario if we get triggered with our exit 1, but then the market reverses and stops us out? Well, if we move our stop loss to break even, let's just say its entry is 99.88, and we say on our second position, we actually exit at $100, which is roughly break even, you still make $1,000. like you still make 3%. You still make net 900, just over $900 when you're wrong. But if you're right, you make 10 grand. This is absolute key thinking when it comes to risk management, because people get overly aggressive and don't think they can be wrong. So we want to go, if we're wrong and we do, basically what we're saying is we get triggered into the market and this happens, you make 3%. Makes sense? That is revolutionary. That is, when I learned that, I was like, what? I can be wrong and make money? And then if I'm right, I make really good money. And if we are right and the market does this in whichever sequence and hits this target, then you make 10 grand. Then you make, what was it? 30, 40% on your whole portfolio, give or take, right? Hopefully this makes sense. So now let's just finish up with doing the entry to exit, or more the entry, because it has been triggered from our previous videos. But the main thing that you're seeing here, and hopefully you're seeing here, is that it's logical, it's mechanical, is objective, really getting rid of the emotions. So now this is our entry point. It's quite a tight entry here. The risk is quite small. Well, it's 3%, it's 3%, but the spread is quite small. So now, bang, there you would have been entered, right? So you're in the trade now. All right, so what do we do now? Okay, the momentum is still bullish. Nothing for us to do until one of two things happen. Okay, the first one is we want to give the market room. We don't want to rush the market. Let it do what it's going to do. Let the psychology play out. The worst case scenario is you get stopped out and you lose 3%. When you let the market go up, as in the momentum, let it do at least one bearish reversal, next bullish reversal, and then another bearish reversal, and then review. If you want to set a price alert, you can do it on TradingView. TradingView, you can do it. You can right click. Anywhere on the chart, I can just right click here, and I can click on add. Where is it? Add alert. Add alert. Add alert. You can get an email if this price is triggered. What's the alert? We want the alert really when we're hitting $144 in that 50% range of that initial minimum expectation. But now let's just play this out. Let's just get to today's date. All right, that's where we are right now. That's where we are right now. We've been triggered. The market's moved up. Doesn't mean it's guaranteed to hit our targets. Absolutely not. Can we still get stopped out? Absolutely. 100%. We can literally, that is absolutely a possibility. And then we just reevaluate, because there's a few different wave counts that we can do. But right now, the probability states we should be sideways to up, and this low shouldn't get taken out. But if the low does get taken out, which is absolutely a possibility, I have to accept that. That's why we have in proper risk capital exposure. Then we just reevaluate and re-enter the market on the next bullish reversal, and then the whole thing just repeats. So now let's just wrap up with a summary. What do I see? Let's just get rid of this. Let's just do this here. This here. There's a key thing that I see that I just want to emphasize. This movement to the upside on the closing data is bigger than any other previous move to the upside. Bigger, right? So it's close to this one, but it's around 10-20% bigger. And that is the first signal of a trend reversal, and it's referred to as an overbalance of price. Basically, the new movement to the upside, very early days. Because remember, the macro picture, what we're looking for, and being patient for, we're talking about 6 to 12 weeks here. We're not talking about tomorrow, but sometimes it can happen very fast in a few weeks. We're looking for this. It's very early days, but we are getting quite intricate because the challenge of any market is when the market takes off and then people buy here, well, most of the money's already been made over here, right? And buying here to here is like a 2x or half, 50%. And buying from here to here is a whole different ball game. So you can actually really get quite intricate and buy at the bottom and sell at the top. So let's just wrap up with this overbalance of price. This movement here. All you have to do now, if you're in the position, is just give it room. There's nothing for you to do. No need to watch the price until you get a price alert. Give it 3, 4, 5 days. In fact, we can do one last thing, and then this is what we'll finish on, just to kind of even help manage your expectations. This is quite powerful. I like this a lot. A typical correction, and we're saying if this happens and this is the minimum and we get a reversal and we get stopped out, the typical time for a correction is 50% of the previous wave. So there's this tool down here called trend-based fib time. I'm going to click this beginning up here, the end of the what we're calling the wave 2, double click, and what we want is 50%. So we should find by February 12th, so less than 2 weeks, we should know where we stand. We should know where we stand. We've only risked 3%, no action needed, job done. So there you have it. There you have it. If you want the course, it's £97. Take my free masterclass by Elliot Wave Fibonacci masterclass because it gives you a flavor of the course, and then you'll be taken to this page, Fibonacci course, Elliot Wave Fibonacci, and it's currently £97. £97. So there you have it. Like, subscribe, hit the bell notification. Today was like a mini masterclass in itself because what I wanted to try and get across is how powerful Fibonacci and Elliot Wave can be to read the markets, and it's not just Solana, it's all cryptos, but you'll find 50, and I cover this in the course, around 50 to 70% of the time, the patterns will be clear, but when they're not clear and there is no pattern, we don't force the count. That's one of the rules and guidelines. If it's not there, we just move on to the next opportunity. If it is there, we act. Now we've got momentum, 2 time frames. We got pattern on 3 degrees of counts, which was a wave 5 of a 2, 5 of a C of a 2. Then we got Fibonacci ratios, and when they all coincide, then there's a very high probability because we can only do probabilities and never certainties. So take my free Elliot Wave Fibonacci masterclass. Getting great feedback because we really simplified it. It's not a simple topic, but I've simplified it. All right, so we are going to cover a quote of the day. Very important, very pressing, because I'm now talking about risk management. Risk management more than profit. You know, keep the money, protect the money. The best traders on the planet are obsessed with protecting capital rather than making money because the markets are going to do what the markets are going to do. The thing that you have control over is identifying your edge, the high probability setup, executing it with proper trade management and risk management, and then managing your position with exit 1 and exit 2. Exit 1 is, what's my insurance policy? Where's a logical place where the market's going to do the minimum more often than not, where I can take a small profit, put it in my pocket, move my stop loss, guarantee a profit, and that keeps me in the game. You know, if I get stopped out, it keeps me in the game. Whereas most people overexpose themselves, risk too much, and then if they do get stopped out or the market moves against them, their portfolio is significantly down, and then they're playing catch up. And if you're playing catch up, that's a very difficult game. Very difficult game. All right, the quote of the day is Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And now I've given you a practical guide of mitigating the chances of losing money because now you have a risk-free point, and then you can just manage your position in a logical, mechanical way. And as the market unfolds, we'll kind of keep a close eye on Solana, but the bigger lesson was that it applies to all crypto. Like, subscribe, hit the bell notification, and I'll see you soon.